Good morning, everybody. Welcome to Fundamentals with Matt Burk. I am your host, Matt Burk, and here today with Dan Dokovic. As you might remember on the show, we're really talking about real estate entrepreneurs that start and manage pooled investment funds, kind of what it's like to do that, why you do it, how you do it, when you don't do it, etc. And today, Dan and I have known each other. I don't know, Dan, when I first tripped to St. Louis out there was probably, 7, 8 years ago now, it seems like.
Probably 8 years ago. Yep.
Yeah, I remember when Dan picked me up at the airport. There's one thing you can't see about Dan on the camera here is that he's taller than I am. When I'm 6'5", I walked down and he got out of the car and I looked up and said, "Oh my God!" Don't normally see people that are 3 or 4 inches taller than I am. So yeah, Dan's founder of Bamboo and Intellica. And so Dan, why don't you give us a little bit of background on kind of you? I know you came over here from Europe to play college ball and then got into real estate. So maybe tell us a little bit about your background.
Yeah, so Dan Dokovic, founder and managing partner of Bamboo Equity Partners, Intellica Commercial Real Estate, Oakline Studio, and McLean Construction. So I have a very, very long, interesting story. Short of it is, as Matt said, I'm quite tall, so they made sure that I played basketball, and so I was decently okay and played. And then I got here to the United States, and back in the day, there was some problems with recruiting of college students from Europe and professional status, and never ended up actually playing basketball. So I had to figure out something else to do. So I got into real estate. I really loved it. Specialized in doing real estate transactions for large corporations for a while with a large outfit out of St. Louis. And then after that, in 2010, left there and started Intellica, which is a property management brokerage arm that we use today still. In 2012, because of all this stuff that happened with the great financial crisis, we decided that, hey, it's a good time for us to get involved in buying assets as well. So we started basically as a consultant to the banks and started buying assets from the banks because there was a ton of REOs back in the day, and that was basically the start of Bamboo Equity Partners. And
yeah, and I know, yeah, I've said to people a lot who ask me about funds, and they say, what are some of the things that make for you need to have in order to justify doing a fund as opposed to one deal at a time. And I always said you really need to have a good origination source or capacity or way to reliably generate deals that are worth doing on an ongoing basis. And a lot of people think they have some secret sauce and they really don't. But something I always liked about your guys' platform is, and you've become even more vertically integrated since we met, if I'm not mistaken.
Yep.
On stuff, but maybe talk a little bit about your platform and how the various companies integrate and how you guys do that.
So yeah, like you said, Matt, we are very much vertically integrated, and that works for us because if you're talking about a deal flow, you have to have your tentacles in the market. You have to know the market. Commercial real estate is very much a localized business. Working for a large corporation before and doing real estate around the country, I noticed that people say they know local real estate, but it really doesn't translate unless you have boots on the ground. And so that's kind of how our company started. We started with brokerage first, and brokerage fueled the deal flow. The brokers found out, well, this bank is foreclosing on this building, or hey, this guy needs to move, so we're going to connect them with Bamboo. And we have an empty building, and we're going to connect the tenant with an empty building. And as we kept growing, we kept adding those channels. Later on, we added architecture and construction management as well, because again, the more tentacles you have in the market, the more deals you can see, and the more people you can touch. And that's been kind of our secret sauce for a long time now. So.
Did you guys do it with an intent to sort of get involved in the ownership directly and raise the capital, or were you just starting off as a brokerage, not really realizing that you would want to become an owner?
Yeah, we started purely as a broker. That was my background. That was my partner's backgrounds, And the way that the aha moment came in is we were selling at a retail center for a bank. They got foreclosed on. It was an REO asset, and we sold that center for, call it, 35 cents on a dollar. And we thought to ourselves, my gosh, why wouldn't we buy this? And so, as any person in real estate starts first, they start syndicating with their friends and family, and that's kind of what we did. Is we took our hat and went to a couple of friends and family and say, hey, we have this really good opportunity to buy some of these distressed assets, and that's how we started. So.
Yeah, and then that's how a lot of people will start, right? Is friends and family, and then in fact, I always recommend that, is that because people who know and like and trust you are the most likely to entrust you with their money. But then, of course, if your deal flow starts to outstrip your capacity to raise money, then it becomes more and more challenging. So at some point, you guys, and I think this preceded our getting to know each other, not by a lot, but you guys had decided at some point to start a fund. Kind of what was the thought process to decide to start that fund, and how did you guys do that?
So really, the reasoning behind the fund is our deal flow was getting really robust. We started seeing deals left and right, and it was, again, it was perfect timing because it was after the Great Recession, and so we saw some extreme values there, and we wanted to make sure that we can pounce on those values really quickly. And so that was the impetus for starting the fund. We also, at that point, added another partner, Alice Benner, to the mix. And Alice came from the financial advisory part of the business, and so she understood raising the funds, and then she understood adding multiple investors into a fund, and so that kind of helped us out. I focused more on the real estate, while she focused more on raising the funds for our fund product. And the other little bit important thing about our fund product is we always knew what our niche was. So we knew that we're not going to compete with a lot of people who are raising funds. We focus on smaller assets, call it 10 million below, that don't compete with the big institutions. So.
Yeah, and what has the experience been? I mean, I've done this for better part of running funds for close to 30 years, and setting them up and helping people put them together for the last 10, and I've seen hundreds or if not thousands of them. But what's been your experience about what your expectations were going into raising the fund and doing it in a fund format, and what you actually experienced? And what were some of the lessons or differences or things of note that might be helpful to people listening who might be thinking about setting up a fund?
Yeah, so it's interesting. You always want something you don't have. So you're working on deals, and you're passing the hat, and you're doing a deal by deal, and then you say, well, I want a fund, and then you go start raising a fund, and then you see the nuances that the fund itself presents, right? You have to be cognizant of those, just like on the single deals, you have to be cognizant of certain things. And so, what we saw on a fund thing is it is really about raising and placing at the right time. And this is kind of what we've always preached. We are very good at raising the funds and then placing them right away. What a lot of fund managers get into is either they're raising too fast and they don't have enough product, or they're raising too slow and the product is kind of slipping through their hands. What we've done really well is raised and then deployed, raised, deployed. The other thing is, you have to be very cognizant is the assets that you're putting into the fund. You have to make sure that every asset is a stellar asset, because your best asset can make your fund, but your worst asset can tank your fund. And so you really, really have to be due diligent and prudent on what you're doing and how you're forming your fund. And then the call it a third final thing is you have to have good partners, and whether that's a CPA and an attorney, and Fairways has been a great partner with us, being an administrator on our fund. You have to have people that can help you run that fund, because you're going to be out there running, trying to raise capital, trying to find real estate, trying to find deals, and you need somebody in the background to be able to advise you as to what's going on, really what you need to pay attention to, et cetera. And so, you can't lose an eye on that, because that can make or break your fund.
Yeah, and I know you guys have done more than one now, if I'm not mistaken, huh? 2?
Yeah, we have closed 2, and we're about to launch a third one in June. So we've decided on a third one as well. So
Now I know you also you haven't completely stopped syndicating during that time, right? I mean, there are times when something either doesn't fit the fund's mandate, or it doesn't necessarily have the timing doesn't work, or whatever. But so have you've been able to sort of have them coexist, right? Syndicating and running a fund at the same time. How do you manage that dynamic?
yeah, you have to be very clear. So when you're working on your fund documents, you want to make sure that your mandate in your fund is clearly written out. And for us, that is very simple, because again, we're focusing in our funds, we're focusing on a micro strategy. So assets below $10 million, office, industrial, multifamily, that is cash flowing and at least 60 to 80% occupied, right? So that makes it easy for us to choose what goes into the fund and what doesn't go into the fund, and not have any kind of a conflict of interest there. So, for example, let's say we find an empty retail building. Well, that obviously doesn't meet our fund mandate, and so we would typically do a JV on that type of asset, and still go ahead and do it because it's a good deal, but it just did not meet fund parameters.
Yeah. Yeah, and you guys, I'd say, we know we have relationships with a lot of sponsors around the country, and I'd say I'd characterize you guys as really good value buyers, right? I mean, making money on the buy, but I'd say you've struck me as being more agnostic as to asset type. So, because I know we've done together, some retail, we've done some industrial, we've done some office, and we've done some storage.
Yeah.
Right? How do you guys feel about like what you're looking for at any given point in the market in terms of asset types, and how do you reconcile, the variety of different things that you're doing in commercial real estate?
Well, so the interesting thing about us is when we look at a building, we're not looking just at a building as a building is currently today. We're looking at is what is the best and highest use of this building? What can we create out of this building? We absolutely love the puzzle piece of it. So we have taken office buildings before and turned them into industrial, and Fairway has helped us in one of those. We had a great exit on one of those. We've taken retail buildings and turned them into self-storage. We've taken office buildings and turned them into multifamily. And really, again, you have to look at it holistically and see, is this building the best it can be? And if not, what is that new life? And what is the current environment is telling us that this should be? Currently, we're spending a lot of time taking office buildings and changing them around. We're looking at one office building to convert it into self-storage, and then we're looking at another office building where we're looking to collapse the second floor and create a warehouse out of it. But a lot of people are pretty set in their feelings and their ways, and they're like, okay, well, no, but that's an office building. Why would you do anything else with it? Well, it's because we can buy that office building and call it $20 a square foot, or we can buy that retail building $30 a square foot, and we can make something different out of it and spend that money and convert it into something that is very useful in today's market, because not everything's going to work in each market. So.
And you guys, you got started coming out of the great financial crisis in 2012-ish, and then you've, seen a pretty good run, right, for the last decade. And now the environment's a little bit different. But how did you manage, being a value buyer in a market where there's so much money chasing things? How did you manage to continue to find good things? And then what do you see happening today?
The interesting thing about the markets that we experienced, when everything was going crazy, you have to stay disciplined, right? And you you have to have your thesis. And if everybody's buying stuff at 3 cap and your thesis is I'm buying stuff at 7 cap, 8 cap, you can't be choosing and going back and buying stuff at a 3 cap. Now there's nuances here and there, obviously, but you really have to stay close to your thesis. The other thing is you have to have those ears on the ground. When the times were great, you have to have those brokers outside. You have to have those trusted advisors outside, touting you and saying, "Hey, listen, these guys are great closers. They're great people to do business with. They will perform, and they might not pay the best amount, but we know they're going to close, and that we know that they're stellar people." And so even through the great times, we've had a lot of luck finding really good deals that are really good cash flowing deals, and are really working out even right now during the downturn. The interesting thing is, the downturns come and go, and commercial real estate is so cyclical, and you have to pay attention to it. We, as we did come out of the great financial crisis, we're used to these times, and these are the times that you have to be scrappy. It's a completely different set of skills and set of circumstances that you have to go after. Well, what are you looking at right now? Well, we're looking at distress, right? Where can you find the distress? What can you change? And so we're spending a lot of time talking to the attorneys, talking to the CPAs, talking to the banks, and making sure that they know if the distress comes to give us a call the first time. And that's really the benefit of being kind of, again, entrenched in the markets and knowing what's going on. So.
Yeah, what markets are you focusing on? I know you're obviously based in St. Louis, so that's a big one. But what else? How far afield do you go?
So between our companies, we have offices in Denver, St. Louis, Louisville, Kentucky, Charlotte, and Tampa, Florida. And so if you draw a line between those markets, kind of, that's our focus. So going from Denver to Midwest down to Southeast. We actually just ended up hiring a market leader in Charlotte that is going to be our Southeast market leader. And again, the story here that keeps repeating is we want to have our ears to the ground in the local market. So as much as we made a really good run in Charlotte and in Florida, we didn't have people on the ground. And so now we have a person in Tampa Bay and we have a person in Charlotte. And again, the deal flow is looking different than it was before when we were just trying to do it from St. Louis.
So what kind of deals do you see happening right now with everything going on in the market? And obviously there's differences from the last one in terms of the way that it's playing out. And this one's of course driven by the rapid increase in interest rates. So what are you seeing that you think are good opportunities coming up here in the next 6 months or a year or so for you guys?
Well, I think there's going to be a lot of these conversions coming up. You will see a lot of office buildings go back to the lenders. By a lot, I'm still on one hand, I'm still bullish on the office. However, a lot still means there's going to be quite a bit, because there was some landlords that did not know how to run office buildings. They did not have amenities. They did not have daylight. They did not have all the things that people want today as an office building. So you're going to see a lot of those Class B, C office buildings that will come back, and you will have to try to figure out something to do with them. We're right now looking at buying one and again, convert it into industrial because it's an industrial park and it makes sense. The basis makes sense, right? We can buy it at $20 a square foot, convert it back into industrial and deploy it in a market that industrial is only 3% vacant right now. So, and you can't find anything, while the office is 17% vacant. So those are some of the opportunities that you will find. I would say you will find some distress, that's for sure. And I think everybody should keep their eye out for that.
Yeah, and obviously the conversion of an office building into an industrial building, you buy it at 20 a foot. It's like, well, what does it cost to convert? How long does it take? What are your carrying costs, right? So you're going to have an all-in basis on that deal that's that's where really the sauce lies, right? Is like, you got to figure out how to do that. Can you get the permits to do it? Is the zoning going to be right? Is how much is it going to cost to construct? Are there problems inside the building that you don't figure out until after you open it up? And, that's the stuff where I think all the risk lies. And, basis covers up a lot of sins, if you got good property in a good area, right, with a good demand for whatever the end use is. And, I'd say that's where I've seen, if people, get aggressive, they can have problems. How do you manage all of those dynamics internally and still adhere to your underwriting standards?
Yeah, so this is kind of where our platform comes in very handy, and this is kind of why we created this platform. Being vertically integrated, for us, it's much easier to do this than for a two-man shop. It's an investment shop that they go out and they look at a building and they say, okay, well, we'll convert this office building into a multifamily building. It's very hard to do that, and it's very time-consuming, expensive if you don't have the internal resources. So as I said when I did the intro, we have an architectural company, we have a construction company, and we're able to, during due diligence, get the real sense of what it takes to convert the building, right? And so an interesting thing on this industrial building is our architect went into the building and said, wait, this building has 2 sets of columns. That is weird. Well, what he has figured out is this building was an industrial building before. Mm-hmm. They're able to take out the concrete columns and drop the second floor without disturbing the metal columns, and which are later going to stay as a support for the industrial building, right? But a normal person walking into the building and going into that is probably not going to pick it up.
Yeah,
and it's going to take you longer, and it's going to be more expensive to do that. So that's where I like to throw a disclaimer out. It's not as easy as the press makes it sound. You look at Wall Street Journal, and they're like, oh, every office building should be converted into multifamily. We have a shortage of housing, right? Well, it's not that way. There's office buildings that are built, back in 70s or 80s that are deep. You have big internal spaces. You can't convert that into the housing. And so again, there's a lot to do here and a lot to think of when you're going through this process, right?
Yeah, and I've certainly seen the good when people do it well, and seen the bad when people overpay and get into something. And there's a lot of those folks out there right now. So, and on those deals, it's hard to get fixed rate debt too, right? I mean, I think the other thing I've seen you guys do well is get local banks, to put the debt up and be able to fix the rate. And that's certainly helpful in a time when, rates have shot up as high as they can. But normally you get debt fund financing with these variable rates on these value add projects, and, your carrying costs can eat up pretty fast.
Yep, that is definitely correct. And that's what it is too, for the new fund managers or whatever. Relationships are everything, and so when you're building those relationships, we've built really great relationships with our banks, and so again, when the time comes, those relationships pay off because you're really working with somebody who can trust, and you can trust. So
yeah. All right, Dan. Hey, we're coming to the bottom of the hour, so I'm going to keep it tight here. But we're kind of wrapping up a few questions I'd like to ask every guest. But what's one energizing or book, audio book, podcast, quote, something that's inspiring you lately?
Yeah, you're pretty funny here. I'll even do a better one. There's a new book here, and I'm not sure how it's reading out, but this is the new book that I've just read. Very excellent book for anybody.
Backwards, but people can read it. CEO Excellence.
CEO Excellence. It's a McKinsey and Company partners that did this, and really well written book for anybody who wants to run a company. Understanding today a lot has to do with people. And Matt can confirm that. And the really, if you're going to run a great company, you have to have great people. And a book like this is invaluable because, it helps you understand how to deal with the people and all kinds of people and really create a copacetic team that can work on any kind of a problem. And so that is very, something that energizes me is trying to build a great team around me. So.
Yeah, I haven't read that one yet. I've heard of it. I downloaded it in fact, I've got it in my Audible teed up here coming up quick.
There we go.
I'll definitely listen to that one here soon. Anything coming up for you that you got exciting that you're excited about? Well, you got a new fund launching, you said, here in a couple months.
We have a new fund launching. We have, we have a pipeline of some very good deals, very interesting deals. The team is energized around that. They're really working hard. And it's, for us, it's very interesting. We're seeing some very good fruits of this vertical integration. We're seeing brokers bringing deals. We're seeing our back operations working on deals. It's really coming in nicely. So it's kind of really nice from my perspective to sit down and, see my team doing really well and being proud of them. So.
Yeah, CEO excellence, right?
Yeah, there you go.
What's the best way for people to get a hold of you, Dan, if they want? Is email, LinkedIn, website?
Email is probably the easiest way. As much as I have the phone on me all the time, it's very much hard to answer the phone. So email is probably easiest, and then somebody will get back to you within a couple of minutes and say, hey, we can set up a call or whatever. But that's probably the easiest way to do it.
You want to share the email?
Yeah, so it's ddokovic@bambooequity.com. So we can post it somewhere, I'm sure.
Yeah, and then you got your name. Spelling is right there on the screen, so hopefully people will get that. Dan, well, hey, it's good catching up with you, man. I know we've done a bunch of deals. We've talking about one right now. Haven't spoken all that much lately. I got to get back out to St. Louis and come visit the. Look, I don't know. I'm having some technical problems. Sorry. Come visit Busch Stadium. We got to go see.
There you go.
Yeah, that was a lot of fun last time we did that. So, all right, Dan, thanks for being on the show, man. Good chatting with you.
Sounds great. Good to see you, and we'll talk soon.
All right. Thanks, Dan. Thanks, everybody, for being here. Be back next week, episode 11, Chris Benson. Next week. Look forward to chatting with them, and thanks for being here. In the meantime, stay sharp.